Good morning, everyone. We have a special guest today. Very excited. I don't know if he planned this around the meme stock thing. I don't know if he knows Roaring Kitty or not. Actually, we might have to find that out live. Um, but Dave Lauer's here. I'll let him introduce himself, and we'll kind of do a little bit kind of specialized to his expertise at the start, and then our typical live stream topics. Take it away, Dave.
Yeah, thanks, George. Thanks for having me. Good to see you, and good to see everyone joining us here. So my background is, in finance. I currently am the CEO of Irvin Finance. So we've built a platform for individual investors to give them professional quality data and tools on a social platform, and connect them to the companies that they invest in. And so, throughout my career, after I started my career in high frequency trading, but throughout my career after high frequency trading, I've really focused on sort of reducing intermediation in markets, whether working on stock exchange design and helping with governance, or working with regulators, or working with institutional asset managers, sort of all throughout my career. It's really been focused on reducing intermediation in markets. And that's sort of what Irvin is focused on doing, which is bringing individual investors on one side and public companies on the other together, two parties for which markets don't actually work very well, and markets have been really designed to work well for the intermediaries, and we don't think that's how markets should function. So that's just a bit about me, but I've been in markets now almost 20 years, and a lot of that doing quantitative research and analysis, some AI as you guys do, and have a lot of respect for what you're doing and your approach, of course, and that's why Irvin's proud to partner with Prospero. And we just launched our platform publicly a month ago, and we're really excited to see the traffic. And today is certainly a good day to be talking, as we watch what's going on in markets.
Great. That was a wonderful intro, and I'm almost done with my phone responsibilities here, and then we'll jump into exciting topic number one, which is that it doesn't look like GameStop is quite over yet, and we've been seeing kind of some very interesting data on our end. I want to take a live look at net option sentiment for GME. Which I would imagine, yes, back to 100. I was gonna say I imagine it might be back there, but we saw it live, yeah. And actually, we only kind of saw it bottom out in the last 2 weeks at 86. So we definitely
Wow.
saw it staying pretty elevated this whole time.
Yeah.
Now, the other part about it,
But
and
we
what
know
we
why
kind of
now,
saw,
right?
what?
We know why
Hi?
that happened now.
Yes, yes, we know why. And I mean, it's so interesting because I had the comment that I feel like uh Roaring Kitty's kind of a hedge fund now, both in his amount of dollars, and then also in the way that, you know, he like I would say the irony is kind of like uses the news, uses kind of his platform to spread the word about his investments, which is pretty much what institutions do. I would say we
For
see it
sure. Yeah.
more. Yeah,
No, I
we would
I,
see
I
it more
think you
on the
can,
short
and
side.
look at that position size, right? Like that's an institutional position size. There's no way around it. He is an institution now, and he is all in, right? Man.
I mean, yeah, that is one thing. He's an institution in some senses, but not in the sense that, institutions don't push all their chips to the center of the table like that. But I mean, that is the benefit of
Well,
it being your money.
but think about like, I saw an analogy made to the Soros pound trade, right? Like if when you think about institutions, you're right. Usually think about like premier risk management and diversification and hedging and all of that. But one of the most legendary traders and trades of our time was George Soros, and his attack on the British pound, and that was an almost textbook all in, right? And it was a make or break. It made him, and it really feels like we're seeing something analogous to that happening right now.
That actually makes me think of something interesting though. It's there's kind of like the plodding along in obscurity that a place like Renaissance Technology loves to do. And I say plotting, but I mean plotting is in like, they didn't have some big trade where everybody's
Right.
attention got, they stayed, even me when I tell the story of how I ended up at Prospero and how I experimented with nonlinear equations on my own. I thought I could beat the market when I was very young and kind of stupid relative to now. And I remember when I found out about Renaissance, and I was like, oh God, it's going to be hard to beat these guys. They've had quite a head start, and they're
Yeah.
doing some very interesting things. But you have them on one side, and that's kind of like the institution as that gets kind of revered on I would say on the institutional side. But then you kind of have these big bets that get people famous, not just famous in the investment community. Everybody knows
Right.
about the Big Short, and George Soros is
Exactly.
known
Right.
for some big bets like that. So it's an interesting relationship what we're talking about here between good returns and fame, and normally both of those things were kind of isolated to professional investors before,
Yeah.
but
That's
now
right.
we kind of see I'd say roaring kitty for the first time, kind of showing the kind of bets that institutional investors get credit for, as well as kind of you know I would say being as big as any of the big hedge fund managers out there, which is just a fascinating trend change.
Yeah. I read this great book. I think it was last year by Scott Patterson called Chaos Kings, and I'd very much recommend it if you're interested in a different side of finance. And it's it's sort of like the Taleb story of trying to plod along and just hold steady until the black swan comes and be positioned and not have gone bust ahead of it, right? And so I think you can look at markets and success in markets, and there are a couple of different models. And the one in which you're just up steady, 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 it, it's the one that everyone gets told that they should do, and you should be diversified in all of this. But when you look back over the last 20 years or so, you see that that strategy, while good over the long run, it involves a lot of really significant drops, right? And some drops that from a human nature perspective are hard to hold through and hard to continue to put money into the market, I think, when you experience them. And so there's the flip side to that, which is don't worry about that steady increase. Just be ready to slam it when you see opportunities that are asymmetrical, right? And I don't know. I think there's something different for everyone. And of course there's Renaissance, which is they never experience that drop, and
Yeah.
that's
Well,
different. But most people are just not capable of pulling that off, as you found, right?
yeah, I know. I mean, as we're talking about it, I kind of think of two lessons that I'm kind of seeing in the market now that I've seen in different ways. I think of the Ray Dalio lesson, which is if everybody likes something, there's very little arbitrage in it. And when you
Hmm.
start to see all-time highs, you start to say like, okay, do I really like all these stocks that are at all time highs? I mean, of course, by that rule, the tough thing is where I go back and forth, and we're 2x Nvidia right now on a pretty small portfolio. So I'm kind of speaking out of both sides of my mouth a little bit on this one. But you say, okay, it's at all time highs. Everybody knows about it. There might not be much juice in that left, or the juice that you're getting is not going to be worth the premium that you're paying. But you kind of have AI and the AI growth also breaking a lot of traditional rules.
Yeah.
So there's kind of an interesting back and forth. And then the other part of that is kind of the Buffett of it all, which we talked about in our newsletter last week, which is just like he's going to such a big cash position. You see the toughness about what you're talking about in terms of like it's really hard to say, hey, the party's over. And I can't like the big thing that I've seen over the years, and everybody asking me about investing, I'm sure you've experienced something similar where they're just like, oh, I don't know, is the market about to turn? And I'm just like, the one piece of advice I give them is like, you know what, I'm a pretty defensive investor. So I'm always a little ready for it to turn. That being said, I've seen so many more people regret not saying, regret the instinct that, oh, I should be defensive because some people are worried, the perma bears are worried, versus just like betting on the market to go up. That's the flip side. You're not going to do that well as a retail investor, just saying, okay, this is the time to pull back. Because I've seen people wait for years, and I've given this advice to people, and they came back and said, you know what, I did pull my money out, and I saw a few more years of it going up, and what you said to me was the right advice, because it does tend to go up. But I do like to play both sides there a little bit, because it does tend to go up. But what you're talking about is, there's good sides to both of what we're talking about, right? You can
Yep.
have that principle, but you can also say, like, you know what, I should take it seriously if I see a few red weeks, or a
Yeah.
few big red days. And I think that's kind of the happy medium.
Yeah, I mean, I think first of all, from my perspective, it's mostly time horizon, right? And so, um, I had a financial advisor, and they were very good, and one of the things they talked about, and every time I would get skittish and I'd be like, pull the money out, pull the money, they'd be like, no, like that's not how you do this, and the reason you don't do this is because you have to be right twice, right? You have to be right when you pull it out, and then you have to be right when you get back in, and that's extremely hard, and it's unlikely. And even for me, who pays a lot of attention to markets and has a quantitative bent and is always looking at things, I have really, and they were right every time. And so, and it's been true also with crypto for me. So I've the more I trade my sort of long-term holdings, the worse I do, and I generally don't do that anymore. But so there's a side of my investments that are just, I don't touch them and I don't think about them, and I think that is where I have like a 20 or 30-year time horizon on those investments, and so I'm not worried. And then but I have a personal account and I like to trade. I mean, who doesn't? If you're in markets, sometimes you like to trade. And so I have fun with that. And if I lose, it's okay. It's not money that's going to change my life. And if I win, that's fun. And I can brag about that to my wife, and that's about it. So I think it's okay. I think it's okay to trade. I think it's okay to buy individual stocks. I think it's fun, and also sometimes you have some edge, and that's the thing, right? It's hard to have edge in a market like this, and it's in generally that edge is harder and harder every year because of AI, because of quantitative analysis, because of the way market mechanics work. But sometimes you might have some. Sometimes you might have a unique perspective, and sometimes you might just want to invest in companies that you love, and you might want to have a relationship with them. And that's kind of what Irvin is premised on: is that people like to buy stocks, they like to invest individually in companies, and there's nothing wrong with that. I don't feel like people should, there should be paternalism in markets. I think there should be education. People should understand that you should have part of your wealth saved for retirement or large goals in life, and you should think about that differently than you think about the part that you're using to invest in individual companies. And you know what? Maybe sometimes you're going to get those individual company investments right. And if you got an Apple right way back when, or Nvidia, or Berkshire, or any number of premier companies that were probably reasonable looking investments at the time as well, you've done really well for yourself. And I don't see why we should be telling people not to do that.
Yeah, I mean, I completely agree, and where I do want to come back to GameStop a little later, because we didn't touch on one of the things, but this is a good transition to Irvin, and one of the things that you said that I just think is so important, that I think there's a lot of things that we agree on, but I think one of the primary things that both Prospero and Irvin are built around is this idea that it's just like, you know what, I think any responsible investor that cares about retail investors is going to say passive investing has to be part of what you're doing. You've
Yeah,
got to have safe investments. And most retail investors just do not have the time to risk manage
right. That's true.
in the same way, or anywhere close to the way passive investments. But also, the stock market is the biggest wealth creation tool that we have in this country. Maybe the US stock market is the best wealth creation tool in the world, and it certainly is international. So the flip side, and I would say the problem to passive investing, and something that you said that maybe like, all right, it is time to transition, is that you've got to attack the problem of education. If you just
Mhm.
have your money in Vanguard, you're never going to get any better. You're not going to have a growth mindset. You're not going to be able to, maybe you're not at a point today where you can say, I like this stock better than the other one, or I can get the next Apple. But the one thing is for certain, you're never going to get there if you don't get on some kind of growth journey, if you don't join a community like Irvin, where you can learn from others, you can have a
Right,
conversation, you could be like in things like verified shareholder communities, which I think
right,
are really important, because cutting through the noise of what's a bot or what's a hedge fund or whatever, I think is so important to be able to have structures to do that kind of thing. But like that's what both our companies are doing in different ways. And I think there's two big legs to the problem. There's, there's an information problem, and then there's an access problem. And I think the information problem is really what Prospero is trying to solve.
hmm,
That hedge funds are just dealing with much better data, and it's really hard. And the one thing that you said that I actually, think a little differently on is that I think all of the algorithmic trading has made it a lot easier for technologies to clarify things. I really rely on, I think it's much easier to spot what an algorithm is doing than what a person is doing, because a person is very consciously, trying to cover their tracks and beat their opponents. And they're way better than that at computers, which are kind of just like a blunt instrument that are going to show you exactly what they're doing. Now, there are tricks to it for sure. But that's one thing that I really appreciate about it. And I think on the access side, I think what Irvin's doing is really important. And I think there's a funny story that I like to tell, and I told Dave. I don't know if I told Dave the first. I think it might have been later. But I actually have someone who's now come on as the first full time data science hire at Prospero, who I met when we were both looking at the AMC trade,
hmm,
and she's got a great story. She was actually like a NICU nurse that became a technical trader, and then went to data science school and became a data science teacher. And through that transition, of course, we stayed in touch and was a great first full time data science hire for Prospero. But when she first mentioned Dave, I said something about being like, "Oh God, he worked at Citadel." And her like kind of coming to your defense, and us going back and forth a little bit, and her saying something to the effect of, George, maybe you could be like Dave when you grow up. Uh, and I always found that very funny, because, of course, like I met Dave through a mutual friend of ours, and we really hit it off. Where I think we both think that there's few people that I would say both left Wall Street and kind of became so passionate about making things better for retail investors. There are not many of us out there.
yeah,
Um,
yeah,
and I think the really important thing that he's doing is, all the work he's doing with the US government, and the signatures that he's collected. And I think Irvin is a great vehicle for both, organizing around change. Some of the things that we're seeing in terms of the shareholder communities, I think is, kind of being the change that we need to see. And there's a lot
right,
of distrust around all these hypothecated shares.
yeah,
So I
that's
thought
right.
maybe you'd want to like speak to a little bit about like what you're working on, your hopes for the future, things like that.
Oh man, there's a lot in the in everything you just said. So, um, I think that when I look at markets, I do think that there are some fundamental problems, and it's not enough for me to not participate. And it hurt. I feel awful when I see people who that's their reaction is to not participate in markets, because, like you said, it's the U.S. markets, especially, are probably one of the greatest wealth creation mechanisms that we've ever seen. And while there are serious problems in market structure, um, it's not. I don't think that they are enough for people to. There's no alternative. that's going to offer you, the average investor, the same long-term potential. So everything that we do in markets, we try to improve them. Some people think, you need to just sort of wipe the slate clean and start over. And I've said many, I don't see how you do that. I don't see how you do it in a reasonable way. I don't see how you do it in a way that doesn't create mass poverty. It's something where maybe I'm just a bit too pragmatic or practical, but my approach is, you've got a foundation, and for too long, the structure of markets has been dictated by intermediaries. And they have been the ones who have influenced policy and regulation. They've been the ones commenting on rule proposals to the SEC and to FINRA. And that's why markets look the way they do today. They are highly intermediated, and they are skewed to advantage high frequency trading, and algorithmic trading. And there's a very clear reason for that, because for a long time, nobody else was commenting or involved in the discussion. Whereas markets are supposed to serve two parties: investors on one hand, public companies and issuers on the other hand. But they are never involved, or historically have never been involved in the conversation about how markets should be designed and what they should look like. So, when we, about 3 years ago, in fact, this month is our third anniversary for Irvin. And 3 years ago, when we started Irvin, we saw the problems in markets, and we saw the excess intermediation. That's something I've been talking about for a long time, but I'd never really immersed myself in the retail investing community, and it really emerged 3 years ago in a new way on Reddit and Twitter. And I have found it to be an incredible experience, and I found people to be very passionate about markets. I think a lot of people do see how important markets are to a functioning economy, right? That's why the US is the most robust economy in the world. It's because of markets and the way markets function. And I think people see the long-term potential, and they want a part of it, right? They're sick of seeing the wealthy get wealthier without being able to participate in that on the same terms. And and I think that over the last couple of years, a lot of that has shifted. And even though markets have not transformed from a structural perspective, like the expectation that they could over the course of 2 or 3 years, I think is an unreasonable one, right? It's taken decades and decades for markets to get to the point that they're at today, with a lot of influence by people like Bernie Madoff, right? He was one of the most influential people in market structure in modern history, in our time. And it's not like you can switch a flip a switch after that. It takes work and it takes time. And so we have been engaged with the SEC, we've been engaged with Congress. We bring, through our organization, We the Investors, we have brought petitions of 70,000 signatures to the SEC. We've had sessions with Gary Gensler, and we have pushed him to change market structure. The SEC has proposed rules to change market structure. It's all in this sort of sausage making, rule making process. And it's a nightmare. It's a nightmare to deal with it, to try and influence it. You have massive lobbying efforts that are going on to counter what we're doing by the intermediaries, by Citadel and Virtu. And they are pushing hard because it's a cash cow if you're an intermediary. That's what markets are. It's a cash cow. And you're going to do everything you can to prevent that from changing. But I think that we're at a point where retail investors have a new level of respect from regulators, and we have a seat at the table. And at Urban Finance, we've tried to build a platform that is a private market solution to some of these issues, because I believe in private solutions. I don't believe the government needs to help us out at every turn. But I also see us as playing that role from a regulatory perspective, again, to end the level of excess intermediation that we see in markets and to increase competition. That's all we're saying, is that markets should function for investors and issuers, and they should be highly competitive. And if you talk to the other guys, the intermediaries, they don't want that competition. They don't want to have to compete against other firms. They want to siphon all of this order flow off exchange. So every time you open up your retail trading app and you go to buy or sell stock, It goes generally to one of two or three firms. They take the other side of that trade, and your order never sees a lit exchange. It never sees the light of day. It doesn't impact the price. And all we say is it should. Retail should impact the price just like institutions should impact the price. Prices should reflect supply and demand. And that if that was the case, that markets would be a lot more resilient and they would be a lot more informative. And so those are the reforms that we are pushing for. And it's hard to say where things are at because the SEC moves slow, and they've proposed a bunch of new rules in December of 2022, and we're still waiting on those rules. But I'm cautiously optimistic that retail will not go away. And of course, clearly, this GameStop trade is not going away anytime soon.
Yeah, well, I was gonna come back to this, and there are some other things I want to follow up, but on the not going away, obviously, I have my own thoughts on this, but what do you think's going on today with this? Like it died down, then Roaring Kitty's like loading up again. Like,
Yeah.
what do you think's going on?
I mean, as we watched, and you and I talked about a bunch about this, right? As well as we watched sort of this GameStop, the events around GameStop evolve from over the course of last month. There were a couple of things that jumped out. The first thing that jumped out to me was that before he ever posted anything, there was some massive volume in GameStop. The week before he posted anything, that stock shifted. It went up a bit, but then it just held at this crazy level while it just churned like through its float. And then he comes and things go gangbusters, and now he's posted this massive position. I still think you and I are probably, I think, in a similar place on this, that most of this is institutional activity. Especially, I mean, if you want to consider him an institution at this point, then it's all institution. And it's not to say that retail isn't there, and there in a big way, but I think the way that individual investors are involved from a volume perspective likely pales in comparison to what's going on behind the scenes between institutions. And I just think there's like a flat out war going on right now from an institutional perspective. And some people, some firms are trying, to attack other firms through this stock. That's what I think is happening, frankly. And it's kind of a crazy thing to watch it play out on a day-to-day basis. And yeah, there are other things happening. There's Roaring Kitty, and there's Reddit, and that's sort of the backdrop. But to me, what's happening behind the scenes is more interesting, I would say, than the narrative that I think the media is trying to paint, which that's what they want to do because they want clicks, and they need to come up with a story. And the real story is, I don't know, to me, even more interesting, but it's not the kind of thing that you can cover in a good way, because there's not a lot of data out there. There's not an easy way to sort of characterize what's happening behind the scenes, I think, except for some of the stuff that you end up working on, George.
Yeah, I think what we're seeing with net option sentiment. That's it certainly looks like there's institutions that have been staying in this the whole time, even as it's gone down. Maybe you could even say, because we saw it kind of hit a lower net option sentiment, you could even say maybe loading up more as it goes down.
Right.
To me, I think the most interesting question here, and the thing that we obviously agree on, is that there's institutions on both sides of this, and for I think that's an important thing for retail investors to always remember. It's not like this isn't some battle of retail against all the institutions, and I think that kind of mindset is not helpful. There's no way this goes. This is not, anytime GameStop goes up, it's like it's not retail overpowering the institutions. You don't want to think in that mindset, because I think then you end up getting a lot of meme stocks that followed this, like FFIE and like all of these other little ones that I think plenty of
That
people
stuff is
lost
it's been
money on.
crazy to watch these micro caps and all of that. Yeah, no,
Yeah,
I mean, what I would say maybe it's a little more subtle than that. It's obviously there is a fundamental retail presence in GameStop, and when you look at the way that 25% of the float has been removed from markets essentially through direct registration, right? So suddenly the float shrinks even more when you consider like what insiders are holding, right? So I think the number I'd seen before the at the market offering was something like 190 million is the actual free float out of the 300 million. So now you can, maybe add the 40, I think 45 million that they sold to that, but you're still talking about like a free float in the 230 million share range. And today it's already traded 100 million shares. It's just crazy. And there have been that was like one of the highest volume days last week, and we're already, we're there and it's 11:30. And on the days where it was trading, where it was really running, you saw it trading 130, 170, 200 million shares. So it traded more than its free float one day. And yeah, you don't get there with just individual investors, right? That's not so. The reason I say it's more subtle than that is I think it's more like you have this bulwark of individual investors, and they have decided that this is sort of the kind of thing that they're going to buy the shares. They're going to lock it away in a safe, and they're not going to think about it, and they're going to keep adding and keep adding to that for all sorts of different reasons. From a structural perspective, in a short selling perspective, as well as they love the company. And again, I think there's something to be said for that. Then you have institutions that are agree with them. For whatever reason, there's a group of institutions out there that agrees with retail. Either they just see retail as something to piggyback on in this situation, or they have identified or agree with the same type of structural issues that individual investors and social media has decided, right? And so that is the one side, and then the other is the short sellers, right? And so like Citron, I don't know, they came out what 2 weeks ago now. Andrew left, and he's like, they lost 100% something on their last short of GameStop, and they're like, we're coming, we're back, and now they're down, right? And so then you have this group out here of other institutions that are either already short coming into this or putting new shorts on. And I think that's a pretty dangerous position to be in. When we talk about institutional risk management and being smart and sophisticated, I just think the people that have shorted, or the firms that have shorted GameStop over the years, are not smart, sophisticated, good risk managers. I think they failed to recognize sort of this asymmetric risk in markets. And again, I think we're seeing that play out again today. We've saw it play out. It was on like May 13th and 14th and 15th when it went all the way up to something like $80. And this thing is clearly not over. This is it's really, I think, fascinating if you are sort of a student of markets, to watch all this play out in real time, to be a part of it, to be sort of a participant in this, and to have absolutely no freaking clue what's going to happen tomorrow.
yeah. I mean, it's really like it's the only time I find myself being like, what's going on in the German market? Like in these
I
in these
know.
like late at night in the meme stock. So like at the very least, like that's the only time I'm checking the German markets.
It's
But
funny.
there's a few interesting things you said. I think one, I agree with everything you said about GameStop, and I do not want to undervalue the dedicated shareholders that clearly are like believing in a thesis and sticking with it. Like that is what every investor has to do. And you have to be able to go with your gut on it. And there's no good investors. It doesn't matter. It doesn't matter that this fund manager wouldn't do that because of the fundamentals. Every investor has to stick to their guns. And those investors are. And I give them credit for that. I think the distinction that I find it important to make is an idea that retail investors can just overpower institutions, That's what I think on the smaller cap ones. That's where I guide away, where it's like, don't take the wrong lessons away from this.
Hmm.
And it's like Reddit can't just decide that FFIE is gonna go to a moon and have them do it alone. That's not gonna happen. You know,
Oh,
you
it's
can
dangerous
galvanize.
to be in a pump and dump. Like it
Yes.
full stop, it is dangerous. And if there is not sort of a fundamentals story and a structural story and potentially a technical story as to why you're investing in a stock, and you're just doing it because you think it's part of a basket or you think that it might be a spillover effect, then again, remember what we talked about at the start. You have to be right twice. You have to be right on the entry and the exit. And the odds are you're not going to be. And I love the saying, the market goes up on an escalator and down on an elevator. And you see that a lot in these microcap penny stocks, and that's a dangerous place to play. And even the most sophisticated firms tend to shy away from that kind of stuff because there's no capacity for an institution in names like that, and it's dangerous and unpredictable. So I think it's really important for traders, if you're trading and having fun trading, all good, fine. But again, like, don't be risking anything you can't lose in these microcap companies, and maybe don't trade them. I don't know. So,
Yeah, I mean,
yeah.
I think we're the same. I think we're in the same spot on that. Um, but I have a I have a few things that I think interesting things that have come up before we kind of move on to our regular schedule programming. Um, I think the two important questions are uh, one, are these institutions actually in trouble? And I say like in trouble because one of the things that I've heard and I know we've discussed is that like a lot of institutions like in these meme stock trades shorting aggressively and then buying out of the money calls. So the extent that they're actually like in trouble, there's definitely shorts. They're definitely heavily shorted. But the extent that they're actually like in trouble, I mean, we can only really see that if we see a bunch of losses posted or we see things blowing up, and that'll play out. But that's an interesting question because I can't confidently say how much trouble there is versus just a heavy amount of shorts in some of these names. That's I think interesting question one. Interesting question two is I think Roaring Kitty the first time it's an amazing story about the way that he pitched the stock and got in early. Obviously there's movies being made about it. But the question I really want to know, and this one is much more unanswerable, but I don't know if you have any thoughts on it, is like, is Roaring Kitty in contact with hedge funds around this trade? Does he know that other funds are going to be buying with him as he posts, before he posts? Because that's a pretty ballsy move to buy the position that he's buying without any contact with hedge funds. And I'm not going to speculate whether he has it or not. And clearly he was out on a limb the first time. I'm not undermining that at all. But at this point, all of that money that he's putting in, that he's made, that's in his bank account, it's not the same where he's like growing it the first time. What do you think about those two questions?
So on the second question, I'll start there, and I'll say that I'm going to assume the answer is no, because I think if the answer is yes, he's probably got some real serious legal exposure. And I don't think, given that he hasn't exposed himself to any legal issues over the course of the last 3 years, it's hard for me to imagine that he would suddenly do that. What I think is the more likely explanation is that he saw what was happening and he decided this is it. It's about to go gangbusters again. And this is the right confluence of events. He saw all that volume trading. He knew that there were a large set of swaps about to roll over. He saw what was going, that there were things in the options market that were maybe signaling that there was this is another sort of 2021 about to happen. And he said, and he was preparing, because I mean, obviously, a lot of those memes had been prepared in advance. And so I'm going to say I think that he saw it and decided this was the time to reemerge. And because I think if he if the answer is the other, that he's been colluding with funds, Again, I think that's why take that kind of legal risk, especially when you have that kind of bankroll that he's obviously developed over the last couple of years. I think he's got fuck you money at this point, and he's like, I'm going to swing it. Um, in terms of the first question, are there firms actually in danger and
Well,
being
how much?
threatened
The
by?
extent of the pain. I'm not going to. Someone's feeling pain. Like the
Oh
question is
boy,
like
billions of
how
dollars of
like
pain
how
now.
much?
You know,
Yeah.
again, I think it's a really hard question to answer because we don't have the kind of disclosures in markets that we need in to determine that. And it's crazy that we still don't. And it's crazy that when the SEC came out with a new rule called 13F2, which we pushed hard to make that disclosure the mirror image of 13F, which is for large positions in a stock, you need to disclose those individually as publicly. 13F2 is supposed to be on the short side. What do you have to disclose? Because there are no short disclosures in markets. And so, unfortunately, the SEC did not listen to us and did not come out with individual public disclosures like they do in other markets. But I just think it's really hard because there are a lot of loopholes in markets, and there's a lot of loopholes in short selling and rehypothecation, and we've talked about it on our podcast. I'll plug, our Let's Talk Markets podcast, which uh, you know, joined us on a couple weeks ago, and hopefully will again, where we actually sometimes talk markets on Let's Talk Markets, but we usually talk market structure, and we did a couple of episodes with a professor from Dartmouth, John Welborn, on the loopholes of Reg Show, the problems of rehypothecation and chain lending, where just you can take one share and sell it short over and over and over and over again, and there's no good disclosure around that. So on the one hand, you want to think that institutions would not get into short positions that could threaten their very existence because they're sophisticated risk managers. And on the other hand, we've already seen them blow out in the past, and we know that they can keep kicking the can down the road through loopholes and reg show, and that they have successfully on many companies done that and driven them into bankruptcy, which is the ultimate goal of a short seller. We know there's market manipulation and abusive short selling that takes place, just like we know there's market manipulation and pump and dumps, and there's manipulation on the long side in markets, and there's manipulation on the short side, and the incentives are there across the board. So I don't know. It is the only intellectually honest answer I think you can give. At the same time, my gut tells me that, yeah, there are some firms that are so offsides on some of these names that it could be existential for them. And we won't know until it, continues to play out.
Yeah, I think it is two quick things. I think the first thing is that oh, I didn't think Roaring Kitty would be doing anything illegal. I completely agree with you. But talking about him as an institution,
Yeah.
there's a lot of space between colluding and like, hey, are you liking this? You talk to other funds, people like, people thinking about buying GameStop are probably going to give him a call and say, we might be bullish on this. Are you, and he could be saying at the very least, he could be saying that to himself
Mhm.
like, oh wow, like a lot of institutions are calling me about GameStop. That could be a signal right there. I was just kind of saying the interesting conversations, because even like when I was an equity analyst, and I'm not going to get into the long story, but my boss at one point was the largest shareholder in two print yellow pages companies. And even just there, I got a bunch of calls being like, what are you guys thinking? So, I mean, if you're thinking about buying GameStop and you're not trying to get Roaring Kitty on the phone, you're probably doing it wrong. Uh,
Yeah,
but
the
if
only
he's
reason.
taking that call, who knows?
Yeah, and the only reason I think I went down that path is because there have been on Twitter calls to arrest him, calls to say that he's manipulating markets, and it's insane. What an insane take! He's tweeting memes. That's all. That's all he's
Yeah.
doing. And even if he was positioned ahead of time, I don't know that there's anything illegal there. And these same people are not calling for the hedge fund managers who go on CNBC every day to talk their book to be charged. It's such an insane double standard.
Oh, of course. But the Wall Street doesn't like anybody but Wall Street to have any power.
For sure.
That's
That's
the
right.
commentary.
Yeah.
It's not it's and I hope that nothing like that comes of it. And I mean, it's one of the reasons that, we've talked about this, that I no longer trade because I'm making so many recommendations. I just don't even
Right.
want to touch that because, there are people that are helping retail investors are going to be held to a different standard than
Yeah.
people that are helping
I
high
think
net
that's
worth
right.
individuals. That's just something that, you got to accept the realities of the market. And that's the kind of thing that I think we both coach.
For
Um,
sure. Yep.
but I think that's the thing. And the other thing that I wanted to say is we'll just say your former employer. I talked to someone from there. I'm sure you have many former employers who
Just a
said that
couple.
like
Yeah.
one of their most popular um, sell side things is distributing their Reddit analysis of like most likely short squeezes. So that's
Hmm.
when we get to the point of the pain, and you're just like, you know, I do agree that there's people that are going to look at that and laugh and think they're smarter. But that's where I'm just like, when we talk about the realities of the pain, if you're just having this information shoved in your face that, that retail is coming for a stock, it's got to be like, there's some people that are stupid, but I got to believe there's some short sellers at least that say there's a play in this. And it's the play that we talk about where it's buying, but like, to your point, the one thing we super agree on is it shouldn't be such a mystery. It shouldn't be
Yeah.
such a mystery to everyone. Like if people are short, if people are playing both sides, like it doesn't. I agree. It's you're not really in the markets anymore if everybody's just got full transparency to what everybody's doing. Some of it is um, a game of kind of figuring out what your opponents are going to do, and I
Sure.
think it's always going to be that because
Yeah,
otherwise it
and you
doesn't
need to
exist.
be able to build positions.
Yeah,
Would never disagree with that. Like I believe in activist investing and active investors. Like I think you need to be able to build a position, but like you can do that. And then once
yeah.
you do that, there should be disclosure, which is like a central tenet of US markets. It's a disclosure-based regime and that should carry forward not just on long positions, but on shorts. It's crazy to me that it doesn't.
But I think the big thing there, and what I worry about, and we've talked about this before, and that it's just like you see what happened when they, outlawed naked shorting. And then, we have these, basically it happens more behind closed doors. And that's
Right.
always my other worry. And that's always my worry with regulation. That and still until there is some enforcement, the regulation is just
Yeah.
solving part of the problem. And like if, when, how we're ever going to
It's
get
true.
enforcement
Yeah. No, I
is
know, and it's frustrating, and it's not even just that they don't enforce, but even when they do, the consequences are a joke. It's cost of doing business for these firms, right? So, we need huge structural changes in markets. I totally agree with that. I just, it's hard for me to see how you get there, and I think the regulatory advocacy route is the only one that I see that has any potential of getting us there, but it's pretty low. It's still I don't delude myself in thinking it's likely to happen because, it's not just about trying to influence regulators, but uh, it's about the trying to deal with Congress as well. And if you think regulators are bad, like let me tell you about this thing called Congress and how insanely corrupt it is and influenced by donors. And guess what? Two of the largest donors to the GOP, Ken Griffin and Jeff Yaz. And on the other side, it's not great either. Like I'm not I don't try and be partisan about this, but the fact of the matter is that the intermediaries own one side and the other side doesn't seem to be willing to do much of anything material either. So, where do you I don't even know where you go or where you start. But we keep pushing the
well, if you
SEC and at least in Gensler we have a chair of the SEC who's receptive to the arguments, and that's a first in as long as I've been doing this, and he's the third chair that I've been dealing with, and at least he's receptive. It's you'd like to think he's all powerful and can fix things with a snap of a finger, but he can't, and you don't want a regulator to be able to do that either, because then the next guy gets in and will just wipe everything else out, right?
No, I mean, I think they're taking it seriously, and retail investors and people like you deserve all the credit for that. And if there's one thing that, like, as you were saying, and I've never really thought about this, but in the lowest percentage, and I do give you a hard time about this sometimes because I could be a bit of a Debbie Downer on this issue, uh, because of my fundamental distrust for politicians.
I
But
don't blame
but
you on that.
yeah, we're if we're going to tell the story to retail investors that you need to have a growth mindset, you need to try, like, it's a hard journey. Nobody's going to tell you learning to be a great investor. If we're going to tell them to tackle that low probability event, we have to be willing to tackle low probability events too, with
That's
just
right.
as much
Yeah.
energy, just as much focus. We're as in a good position as anyone to do that. So we absolutely, I think it's important to be realistic, but charge ahead nonetheless, because that's the same advice. That's the exact same advice I'd give any retail investor learning how to invest.
Yeah, 100%. Yep.
All right, Stephen, we'll tackle some of we can tackle this
Any
was a great
questions? Yeah.
we have our
We talk
regularly
AI
scheduled
too, right?
programming now. Yeah, we've got some topics. See, I think this is the longest Stephen has ever gone in one of these live streams without coming in, but let's do the regular scheduled topics.
It was fine by me. It was fascinating listening to you guys speak, and I think it's really cool the level of depth that you guys can speak on certain topics. So I think what would be great for our audience is we kind of hit on the topics that are like ongoing topics in our stream. So yes, AI is definitely one of them. We saw announcements from AMD and Nvidia over the weekend about new chips development, and I wanted to put it to you both of what inning are we in AI now? It's been around for just over a year about now, seems like, and I think it's good time for an update.
You want to go first, Dave?
Yeah, I think, and I think I know where you fall on this, George. So I'll sort of agree and disagree that we're like, it's, I think there's a good argument to be made. We're in like the first inning, like maybe even the top half of the first inning, that this is a revolutionary technology that's going to change the economy, it's going to change the world, and we're just starting to see that, you know, get going now. So I fall into that camp, generally speaking, with a big but. Um, I think it's still, for the state that it's in today, completely overhyped, and in a massive bubble. And and I say that because I I think, as in the past with AI, we have often seen a lot of promise, and then it hits a wall and you end up with another AI winter. And that's happened many times now. And it's something I've paid attention to for a long time. I did a lot of work both in AI over in recent times, and I was in an AI and robotics lab when I was in university. And I spent a lot of time studying it now, again, 20 years ago, more than 20 years ago. But I think that the current level of technology and deep learning, I'm not optimistic that it is as revolutionary. What we have today is as revolutionary as people want to spin it and make it out to be. I think over time we will figure some of this stuff out, but to me it's a really long time horizon for AI to do the kind of things that I think people are trying to spin it as being able to do today or in the near future. So I'm still a big believer in technology, but I think we're getting way past our skis right now.
Wait, so you saying, are we in that we're in like the like we're not even in we haven't started the game yet?
Yeah, I would almost say that, or we're like, we're in the first inning, but it's about to be called on because of rain, and we're gonna have to resume the game after the storm passes. How about that?
That's interesting. I mean, I think it's maybe just because maybe I've been around it for so long that I actually, and I've heard lots of people say like first inning. Um, but I would actually say we're more in like the third inning, and not because I actually disagree with anything that you said. I think that like the actual like AI, the way we think of like AGI or robotics or things like that, like we're very far away from that. I think we're very far away from it. Really solving like the most complex problems that humans can solve. In terms of things that are just like more like about the logic centers of our brain, things like that. I mean, one of the things that I do really find funny is it always says that like things like art are what AIs will never solve. And we are seeing like a lot of like art and music and things like that, which is just funny. It annoys some people that are more on the artistic level, and I think that's kind of funny. But the reason I call it a little different, I call it a little differently, is because of the way AI is here now, not in the AGI sense, and not in the like, not in the like the robot that talks to you kind of sense. Um, I'm thinking anytime you're on social media, you're basically and have been interacting with an AI that's taking in massive amounts of information, figuring out the best way to get you to interact with it. And obviously that part's been around for a little bit. And yeah, I mean, I think the issue of like, is AI overvalued, or is it like, I think there's the real speculation on it, and there's the real chips that a place like Nvidia is selling, because everybody is going to commit to AI, whether or not it's like the real futuristic AI or not. And obviously like very real crazy numbers to boot. And now we're talking about 3 quarters in a row where I'm saying this is the best quarter I've ever seen any company post that Nvidia did. So I think we have that, and there's a lot more to come. But I do give a lot of credence, and even things like we are seeing some full self-driving and things like auto park, and I think smart grids are, I think, something that are becoming more and more realistic, and we have like some of our first smart cities and things like that. um so yeah, I think we agree on the fact that we're getting a little ahead of our skis in terms of like what the capabilities will eventually be and where we are now. But I think it touches our lives more now than a lot of people kind of give it credit for.
Okay, no, I think that's totally fair. So I don't want to sort of mischaracterize the way I think about it, because I completely agree with you. Although I think, to me, even the things you just cited, much of that is the result of sort of incremental changes as our quantitative sophistication has increased. And I guess I'm really more thinking of like the AI as people conceptualize it, maybe AGI, or maybe just something that is so sophisticated that it's able to really perform well on things outside of its training data. And even though a lot of the things that we see today look impressive, most of the time that's because it tends to be trained on the things that you're asking it. And so I think the systems are really good at looking good and not very dynamic or adaptive to the real world or to a complex world outside of their training sets. And so when people think about AGI, I think we're so far from that, but I think we're now on the path to that. I guess
Yeah.
that's how
I
I
mean, I think
think
if
about it.
that's
Yeah.
the definition, I think we're just going to go straight from like your 4th inning to the 9th inning right away. That's
Right.
my philosophy on it. I think it's going to be much like ChatGPT, where we're going to like come along and then all of a sudden this like,
Yeah.
I
Where the
hope
hell did
not
that
in
come
our
from? Yeah.
lifetimes, because I don't know if it's good or bad. Like all of a
Right.
sudden
Yeah.
there's going to be this AGI that's just in our lives, like very like profoundly. And I do kind of hope that is not the case. That it is in our lifetimes, because I mean, it could be great. It could not be great.
Yeah, that's right. I mean, I think you're spot on. I'm on the editorial board of the Journal of AI and Ethics, and it's something that the journal deals exclusively with, is like these questions of alignment, and how we can build systems that are safe and ethical, and unfortunately no one's really doing that.
Well, I don't know if you've ever read Artificial Intelligence, but it's my favorite AI book.
No,
Um,
no, that sounds
and
good.
and
Yeah.
it boils down. Oh, you'd love it. Like it boils down into one really important thesis that's just like robots are better at production, and they will always be better at production. So
Yeah.
as long as we orient around gross domestic product, we are screwed, because there will be just like a societal overhaul, because they will win on production, and there's like if that's how you're going to be measured, there's no win,
Yeah,
because
right.
they will win on production like completely. So like they actually like the guy's like, well, I don't think we'll ever be like Tibet where we're going to be like gross national happiness. But if we don't expand the measurement systems to include like things like quality of life, maybe a downgrade from, from happiness, because America's never going to care about happiness, but we might maybe care about quality of life. But I think that's a
Maybe,
very
yeah.
interesting perspective on AI ethics, because I think that's really the conundrum, where it's just like, unless we change these measuring systems, robots are like the, kind of end game on the highest efficiency as far as
Oh, for sure.
production is concerned.
I think they're very good at what they do, and they're, it's going to sweep all sorts of industries and completely change the face of all sorts of industries. And so, I mean, that's why I'm actually a proponent of universal basic income, because I think like there is really no other answer to, what the future of 50 years is going to look like, and we should be preparing for something like that. And that should be seen as a great thing. Like, humans should not have to live subsistence lives in an era where there is not real resource scarcity. But now, I want to see I want to see Star Trek. That's the world I want to see.
Yeah, no, I mean, I think I'll say it a little differently. I think there will be universal basic income, or there will be revolution.
Yeah,
Like
yeah,
that's
that's right.
that's it. And I think we're at a point where I don't think revolutions would go very well for the revolters.
I
So
don't think so either.
I hope
Yeah,
I
I
hope
don't want to
that's
see
not
that. Yeah.
yeah. So universal basic income would be way better.
Very interesting stuff there. So I heard, Dave, I heard you mention before crypto. So I'm interested to see if we'll get a nice debate here, because I'm not sure if you and George agree on this exactly.
I
There
don't
was
think we do.
Yeah. So there was a story today about Michael Saylor and MicroStrategy paying off a tax fraud case for 40 million. I just wanted to use that story to
Oh,
get into crypto. If you could share your opinion on Bitcoin, crypto, the future potential impact on the financial markets for it, and so you can begin, Dave.
I think on crypto, either you think it's the future of money, or you think it's all a giant, scam. And or maybe I think it's both, because I think there's a lot of scams, there's a lot of fraud in crypto. But I do think a decentralized peer-to-peer technology is a really exciting and fascinating one. And I do think that there are some that should be the future of money and money transfers and that kind of thing. I think people having the ability to essentially be your own bank is it's a really cool feature of a monetary system that we haven't had before. And so I think some of them will win out. So, I think Bitcoin is around to stay. I think it's new gold. And I think there are other crypto technologies that are really exciting from a technological perspective, and ones that I've invested in because I like the technology. And generally, a lot of those have been right. Like they're the ones that are at least starting to win out. But I think that the problem with crypto, like the problem with any financial technology or financial system, is fraud, and people getting ripped off. And so, I think from a regulatory perspective, we've been in a tough place without a clear sort of cop to police the industry. And I think Congress has really failed from that perspective. And I think some states have tried, but it's tough. It's a tough thing to police. You need a lot of technical sophistication, and you need enough budget to do that. And so, I think that the future is some hybrid system with crypto, probably with CBDCs, and some real innovation happening in our monetary system, and I think that's a good thing. But I think we need I think you need actually cops that are policing in the industry, in order to get there, and I don't think we have that right now.
Yeah, it's kind of funny. I mean, people that watch these streams, I think, are gonna like. I've said this way too many times, but maybe Dave can push back more than well, I don't think he is going to actually more than Stephen does. But I mean, I think blockchain technology is the future. And I also think there's amazing long-term investments in I would say more blockchain than crypto, but I do think there's reasonable reasonable arguments to be made about the future of, I'd say, both Bitcoin and Ethereum. That being said, I think where I really bump up against it is, kind of something that we've talked about a few times, like timing it. And for me, I always like it, especially in certain markets, and I think it's still true in this, that you're better off understanding the things that you can understand. And that's why I always kind of recommend on the long side, well-timed blue chip stocks, large caps, mega caps. Sometimes I do mid, and it's just like, it's more of a substitute good for me, where I'm saying like things that you can understand, and using things like our net option sentiment or other options metrics. I think you can just get a better grasp on the timing of something than you can with crypto, which where I talk about all the time, where there's non-transparent leverage markets. You don't really know where the bets are, especially in real time. And connecting those two thoughts, that's kind of my problem. I don't know if I can't see where the leverage is at all. I don't know if I'm about to get into a crypto or a blockchain investment that's about to go down 30%. I have a much better understanding of what I'm doing in the stock market on that, and obviously make recommendations around those things. Were that to change, I'd very happily invest in it, because I do think it's an excellent long-term investment. The problem is kind of the ROI, time value, substitute good thing, because it's just like, hey, I can churn over, NVIDIA maybe a few times before then buying my blockchain or crypto investments when I can get a better handle on it. And I might miss the boat on it, but I'm thinking like of like a big climb, and you could certainly argue that I did this year, but I think the risk reward profile is just something I'm much more comfortable with when I can understand the derivatives markets. And I've built tons of models on Bitcoin, Ethereum, and it's just like, it's highly unreliable, way more unreliable than my stock models. And I just can't really get on board with anything or recommend anything on that basis. But I do think it's very, very promising, and absolutely the future. But the one thing that I do say about Bitcoin, and it sounds like Dave's very confident in Bitcoin, and I'll admit that I haven't done as much work on it as probably he has. But the thing that just makes me nervous about it, as someone that maybe doesn't understand it as well, is it's just like, there's so much. It's kind of the Ray Dalio thing where we were talking about at the beginning. There's so much pricing built into it on it being the winner. There's just too big of a risk on that specifically for me, on another currency coming and threatening it and making it not the winner. Even just the threat is something that could really make it go down a lot. And that's kind of where I land on all of it.
Yeah, I think that those are all like really reasonable points, and I totally respect that, especially if you have a process, if you have an approach to investing in markets, and crypto doesn't have the same type of thing, the same data or the same kind of markets that you would feel comfortable in. That makes sense. I threw out the word edge earlier in this conversation, and I'm a big believer in, you should generally only invest in something when you feel like you have edge. And crypto has just been something for me that I've been in on very early. And so that being so early on it, I think has put me in the position to have edge in maybe only a couple of occasions, but like originally buying Bitcoin, it felt like this was something that was a promising technology, and not a lot of people knew about it. And that was a great trade.
When did you first get in? What was it at when you first bought it?
So Bitcoin is both my best and my worst trade ever. So I bought 100 Bitcoin for $200. That was my first Bitcoin position, and it went up a lot. It went up to like
To say the
$1,000. Yeah, but
least.
when I mean, this was like 2010, then like by 2014 it went up to like $1,000, and I was like, what? This is insane. And sold that position over the course of that first rally. and was really pretty pleased with myself. And of course, again, like that was the highest return of anything I've ever had. And now, I would be, sitting on an island somewhere if I had just kept, that position and maybe added a bit to it. So, but I bought back in and decided I'm not going to sell again. And I can say every time I've sold crypto or crypto position, I've been wrong. And I've had three sort of core positions that I've created. The first was Bitcoin, the second was Ethereum, again, early days, and it seemed very promising. And then the third, which I think was the thing that the investment I made with the most edge, I would say, which was that when I learned about this one called Avalanche and I saw their approach, I said, this from a technological perspective, I think is the coolest thing I've ever seen in crypto. And it's a proof of stake. And this is not financial advice in any way. I'm just, the process I went through when I found it was, this was a proof of stake currency. It was a sub-second finality. They've got this concept of subnets. It's just a fascinating approach from a technical and technological perspective. And so I bought a good amount of that very early on. And so I haven't had something like that happen again in crypto since then. And so I sort of hear you that I'm not sitting here trading crypto and I'm not sitting here developing models trying to understand where to put money. For me, it's always been more of this is an interesting technology. I'd like to have a piece of this, or the NFT market is going crazy. I'm going to buy 5 and now, they're eventually going to be worthless. So, that's like buying microcap companies. So like anything I've done in crypto, that's the equivalent of like buying microcaps in US equities has not worked out. But anytime I've done sort of that, maybe what you call fundamental analysis on an actual piece of technology, I think it's gone pretty well.
Yeah, and I mean, I think it's so funny. You just kind of told your story is exactly how I see it, right? You got in, you knew it was promising, but even someone that's early that got it, that like has done so much research,
Yeah,
you fumble around with the timing, right? Because there's
that's
not
right.
like
Yep.
there's no good indicators, and like that's and I think there's some people that are comfortable, like to circle back where we started. There's some people that are comfortable in that zone,
Right.
and
Right.
and I'm not. You know, everything like I've got to dot every I. I've got to be able to explain everything, and if I'm not there, I can't recommend it. But I think that's the important thing too. That I think we're both emphasizing, where it's just like you still got to do what makes sense to you and what fits your risk profile. You want to try to manage your risk profile. But if there's one thing I always emphasize, it's that this is my process, and I'm happy to teach my process and advise people on it. But I'm not really in the habit of criticizing other people's processes unless that process consists of like buy X. Like that's the only time. That's the only time I'm just like, well, is there anything more? Maybe you want something more than that.
Yeah. Yeah,
That's
that's
really
right.
the
Right.
only time that I like stick my hand up and I'm just like, have you thought about an investment thesis that's just like a little more than that?
Yeah, no, that's right. I mean, I think I agree, right? Like you need to have a style, you need to have a level of comfort, and and that's not like an easy thing. It's not an easy thing to develop, and or to stick to, and it can take a lot of pain over time to get there, and that has for me with crypto. I mean, again, like I should be fabulously wealthy thanks to crypto, and I'm not, and that's okay because I've learned a lot along the way, and uh, I think you get to a point where you hopefully find some comfort in your approach to how you invest and how you allocate funds in markets and how you plan for the future. And but it's a very personalized thing.
I think you got to take your lumps, and that's the truth,
Right.
and that's one of the reasons why I'm just like, as long as someone's trying, like I've got no problem being like, well, that wouldn't be how I did it, but like, because until you take it, have that growth mindset, and until you like take your lumps, we've both taken, like that's how you get better. That's
Yeah.
the only way. Like I don't learn very much from being right. I learn like orders of magnitude more when I miss things. And so you
I
got to get
usually
out
learn the
there.
wrong things when I'm right.
Yeah, exactly. So you gotta get out there. Hopefully, not wager too much money while you're learning those lessons. And that's the one thing. Dave actually introduced me to Eric, who was on and did a great options lesson last week. And that was the one thing that I think he just stresses with options. And where I'm always just like stay away from options. He's always like paper trade options. And I think that
Mhm.
that's like that's probably even a better answer than my stay away from options. But I always get nervous on even the paper trading where someone makes a bunch of money paper trading and then they try it live and it's just like
Right,
it's like
exactly. Yep. And
that's the
that's a
point.
problem,
That's
right?
the point that you're making. But
Yeah.
I think the flip side to that is like you make your like you'll probably take your lumps paper trading just as much as you take your lumps on anything else, as long as you're not just like having one trade and being like, oh, I get this now. Maybe try 10 before you decide if you know options on the paper trading discussion.
Yeah, that's right. Yeah, be careful with options. That's all. Again, it's like I actually like trading options. I have fun with it, but it's got to be pure fun. I like the asymmetric nature of options as long as, you're managing risk appropriately.
Yeah. Well, selling risk. That's what I love about options. You know, selling
Right.
risk is better than buying risk, in my opinion.
Hmm.
That's how the institutions really make their money, or being neutral to risk and collecting fees. That's the best way to do it, but that's not really that's not really available to a retail investor.
No, no.
All right, I got 13 more minutes before I jump to another meeting. Just letting you know, Stephen, to manage the topics accordingly. We don't have to get through them all.
Yeah, I think we have one more main segment that I think would be good for both of you to share your opinions on. So I want to take a gauge on how you both feel about the strength of the economy. It seems like we have so many competing narratives going on. George and I have talked about how McDonald's and Walgreens have been lowering pricing. I just saw a story today about how Spotify is raising pricing. I don't know if there's something to read in the digital and physical nature of those businesses and how they're able to maintain that pricing power. But also, we have the AI tech wave. We have consumer credit hitting all-time highs. So I guess we'll start with Dave, just how you feel, and then maybe if you could predict where you see it going towards the end of the year.
Um, I don't know. It's I talked about the podcast that I do earlier. Let's talk markets, and we on a somewhat regular basis. It was monthly. It's now maybe every other month. We do a macroeconomics episode, and we have a couple of regular guests. Claudia Sam, who used to work at the Federal Reserve, Ophir Gottlieb, who runs a great website called Capital Markets Laboratories, and Kyla Scanlon, and who just has a new book out. And we try and figure this out. We try and figure out what's going on with inflation and economic growth, and where is the Fed in terms of their outlook on markets, and are they going to cut? And I think all of us were expecting a cut by now, by June especially, and are surprised and frustrated that it hasn't happened. And I think we're starting to see indications that they are too high for too long, and that's going to impact employment, even though employment numbers have been pretty good, and holding up very strongly. I think you're starting to see some chinks in the armor with the latest employment reports, although they were mostly in line. But you're also starting to see signs of contraction from industrial indices like PMI, which I think came out today, and it came out much worse than the market was expecting. But it's sort of been overshadowed by GameStop. And economic growth, the quarterly GDP was close, in line with expectations, but still low now. I don't remember. I think it was like 1.6% was the last reading. So, I think there are a lot of signs that the economy is tightening right now, and that the Fed is holding rates too high for too long. By the end of the year, I hope they have figured it out, and I hope we are not in a full-blown recession. I don't think we're in a full-blown recession, and I think the inflation numbers, even though inflation has caused pain, wages have kept up or exceeded the growth rate of inflation. And most of the inflation, when you look at it at this point, is concentrated in auto insurance and owner equivalent rent. And so when you see like a 3 handle on inflation, if you actually pick it apart, you're starting to see disinflation in food prices and now starting to see outright deflation in some areas. And that's obviously a problem. We'd much rather see disinflation where that growth rate comes down and wage growth stays well above it. So I guess I hope the Fed figures it out quickly, starts to cut rates, maybe gives us, what would be at this point a surprise rate cut before September, because the market's really pricing in the first cut in September. And I think that would be a good thing for the economy and for the market. So that's what I hope. What I fear is that they're not going to do that, and that by the end of the year we're really in a full-blown recession, or even worse, a stagflationary environment. And right now, that's not the case in terms of stagflation. We're not there, but we're not far enough away from it that I'm comfortable. And so, I think there is a real risk of that on the table. And I also think there's a real risk that that kind of thing, depending on timing, influences the U.S. election. So, you've got the election on top of all this, which is kind of, a something that's really throwing things off, and it's throwing off policymakers, I'm afraid. So, I don't know. I see some real risks. I'm still, let's call it cautiously optimistic that they're going to pull this off. But they've never really pulled off a soft landing, and so it they really nailed it up until I feel like the last quarter, and now it feels like they're gonna end up being reactionary again, and that's gonna be a big problem for the economy towards the end of the year.
You know what? I see it just a little differently. I agree with pretty much everything. I mean, I agree with everything that you just said. And I mean, except with one slight change where it's just like, I'm not as sure as you that a cut would be good. I like overall. I agree with what you're saying that we might be getting ourselves into trouble in some sense by not having a cut. And I'm like looking at like the pure economy on one sense, in terms of like, yes, I think we are definitely jeopardizing a soft landing by keeping them up. But then I think about the stock market on the other end, and I look at this scenario, and I'm just saying like one of the things that I've talked about these rate cuts in this sense is that it seems to me that for a while Powell was kind of saying like, well, if I don't need to cut to make sure that the stock market performs, then I'm going to take, or the economy or whatever, I'm going to take as kind of as much slack as I'm given. That's kind of, if I hear the subtlety of what Powell's been saying, and looking at the data, that to me is what he's been saying, that I'm going to take the slack, because we basically, the only time we have seen him kind of say like, oh, a cut might be coming sooner or whatever, is when banks have collapsed or things like that. So he seems to be saying like, unless I see real problems, I want to take as long as possible. That's one thing that I think I'm seeing. So why might I think what you're saying is maybe a little more complicated from my vantage point? I think if there were cuts, if there is a cut now or whatever, I think we might see, we're already seeing all-time highs in the market. I think we might see such velocity of the market going up that we're really almost asking for a market crash. And it might actually be better to let it get a little, to start maybe seeing some of those difficulties a little more tangibly, the market starting to go down a little bit more before you kind of start to manage it with the cuts. Like if I had to guess, I think that might be what they're thinking, especially with the election coming up. Because you start cutting rates, the market goes to the moon. And like, let's say there's problems with the election. We're just going to say problems broadly. And, there's starting to be economic problems. That could really be a severe market crash. Whereas if we don't necessarily get that same boom that would come from a rate crash, we might be able to manage the market side of it better. That would be the only difference as I see it.
Yeah, I mean, I think it's all fair points. I think the Fed has been stellar in this cycle, in staying ahead of the, in terms of forecasting and staying ahead of things. And I say that understanding that the bout of inflation we saw was probably equal parts monetary and fiscal policy. And so, I think they really screwed that up in terms of allowing inflation to get ahead of them. And I don't know that they could have done it well because COVID was such an insane and unpredictable and complex irritant, which is what Ophir likes to say on the podcast. COVID was the irritant, and now we're seeing the effects of it, and we still are. We're still seeing like this craziness in supply chains that has led to this inflation. But it's dissipated so much at this point. And so I don't know that they could have been better. It's easy in hindsight, but I think since then they have managed the soft landing really well, better than I think anyone would have expected them to plausibly have done. But at the same time, it's really easy for that to tip over the edge and to turn into to be too contractionary. And yeah, I get what you're saying. They want to see the numbers, and at the same time, because of the nature of how we measure things in the economy and all of that, but by the time you've seen the numbers, it's just about too late, and then you're turning into your response is reactionary, and that's when the Fed is really bad because they'll always overshoot, and if they let it get to that point where they're waiting to see the numbers, they've overshot one way, and they're going to overshoot the other way, and it seems like it's a shame that it was like a wasted opportunity to actually not do that this time. But it's easy to say that when you're sitting here and not like in the room making policy decisions.
Yeah, I think it's I mean, I completely agree with you. If there's one thing they've done a great job, if there's one thing to pick at, it's that they were a little late to start, and you'd hate to see them, be late again, especially if that lateness meant that we kind of saw more, especially job loss than we needed to. I think that's really what we don't want to see. I just yeah, I just think that they're probably worried, like, especially, and I'll say it a little differently. I think if this wasn't an election year, I think they would cut, or they would have cut already, or maybe they cut next.
Yeah,
But I
I
just
think
think
that's true.
there's
Yeah.
too much risk around, like, the power transfer, everything that's going on. Like, if you're talking about like markets like continuing to break circuits, and then there's like, potential political problems and potential economic problems coming with an all-time high in the market, like, you might have another Great Depression on your hands, and maybe even worse because of some of the AI stuff too, where you actually have like, kind of structural job loss. And then in addition to the structural job loss, you have, AI coming for new jobs that were outside of that previous structure.
That's right. Yep.
All right.
All right. I like you. I have to go at 12:30, but I've really enjoyed this.
Dave. This
Thanks
was
for having
great.
me on. Really enjoyed it.
Thank you, Dave. It was a wonderful conversation. For everybody who's tuning in, we'll be back regular time Wednesday, 3 p.m. Bye, everyone.
Bye.